your bank might already be selling you Bitcoin, and you may not even know it. One of Canada's biggest banks just quietly launched its own crypto fund, and another one just poured $150 million into Bitcoin ETFs. I'll show you exactly what they bought, what it costs you, and whether it actually belongs in your portfolio. But first, let's get your bearings. I'm your crypto compass. Let's get your bearings. By the end of this video, you'll know exactly what Scotiabank and BMO just did, how their new products compare on fees to what's already out there, and the one question you should ask before putting a single dollar into either one. Stick around, because the answer to which should you actually buy this isn't what you'd expect from a bank-backed product. This week, Dynamic Funds, that's Scotiabank's asset management arm, teamed up with 3iQ to launch a new fund called DXMC, the Dynamic Active Multi-Crypto ETF on CBO Canada. DXMC isn't just a Bitcoin fund. It gives you exposure to 4 assets at once: Bitcoin, Ethereum, Solana, and XRP. Actively managed, with a reduced management fee of 0.25% through March 2027. And Scotiabank isn't alone. Bank of Montreal quietly disclosed that it now holds roughly 150 million Canadian dollars in spot Bitcoin ETFs, including BlackRock's IBIT, sitting directly on its own balance sheet. So, in the same week, 2 of Canada's big 6 banks went from crypto-curious to crypto product providers. That's a real shift, but it raises a question most headlines aren't asking. Does a bank's name on the label actually make this a better investment for you? I'll get to that. But first, you need to understand what's actually inside this fund, because it's riskier than most people assume. Here's the part that gets glossed over. Bitcoin and Ethereum are the 2 most established crypto assets by a wide margin, but Solana and XRP behave very differently. They're smaller, more volatile, and both have had double-digit swings in weeks where Bitcoin barely moved, and sentiment right now is genuinely mixed. Different trackers this week have ranged from extreme fear in the low 20s to neutral in the high 40s, depending on the source. That divergence itself tells you something. Nobody has a confident read on this market right now. And a 4-coin active fund inherits all of that uncertainty at once, not just Bitcoins. Actively managed also means someone at Dynamic Funds is making calls about how much of each coin to hold and when. That can work in your favor, or it can underperform simply holding Bitcoin outright, especially once fees stack up. Now, here's where it gets interesting for anyone who already owns a Bitcoin ETF, because the comparison isn't as flattering as the press release makes it sound. Let's put real numbers next to each other. A straightforward spot Bitcoin ETF like BlackRock's IBIT or Purpose Bitcoin ETF typically charges somewhere around 0.2 to 0.4%. DXMC's promotional rate of 0.25% looks competitive on paper, but that rate is temporary, only guaranteed through March 2027. After that promotional window closes, active multi-asset crypto funds in Canada have historically reset to fees closer to 0.75 to 1%, 3 to 4 times more than a plain spot Bitcoin ETF. That's not a reason to avoid it outright, but it is the single most important number that today's headlines are leaving out. And it's exactly the kind of detail that determines whether this belongs in a long-term account, like a TFSA, or whether you're better off with a simpler, cheaper product. So, how do you actually decide? Let's break it down. If you already hold a spot Bitcoin ETF, DXMC mostly adds Solana and XRP exposure, Ask yourself if you actually want that risk, or if you're buying it just because a familiar bank name is attached. Read the prospectus. If the post-2027 fee isn't clearly disclosed yet, that uncertainty alone is worth waiting on. Both DXMC and BMO's ETF holdings are exchange-traded products, which generally means they're TFSA and RRSP eligible. But eligible doesn't mean ideal. A volatile, actively managed 4-coin fund behaves very differently inside a tax-sheltered account than a single established asset does. The real takeaway isn't banks are buying crypto, therefore it's safe now. It's that a familiar logo doesn't remove the two things that actually matter: what you're holding and what it costs you to hold it. A bank's name on the label doesn't change what's inside the fund. Read the fee schedule before the logo convinces you. If breaking down what these headlines actually mean for your account is useful to you, hit subscribe. I cover exactly this kind of Canadian crypto news every week before the fee fine print catches you off guard. This isn't an isolated move. Canadian banks have spent the last 2 years going from ignoring crypto entirely to quietly building products around it. And DXMC and BMO's position are just the two we can see disclosed publicly this week. Expect more of this, not less, especially as institutional demand keeps rising. That's actually good news for market maturity. Bank-distributed products mean more oversight, more disclosure, and more competition on fees over time. But it also means you'll see more headlines exactly like this one, dressed up as a reason to buy in immediately. The tools I gave you today: check what's inside, check the fee after any promo period, check where it actually belongs in your accounts. Apply to every one of them. So, should you buy DXMC or follow BMO's lead? That depends entirely on whether you already have Bitcoin exposure, whether you're comfortable with Solana and XRP swings, and whether that fee holds after March 2027. Now you know exactly what to check before you decide, instead of just reacting to the headline. If this helped you cut through the noise, subscribe and hit the bell. I break down what Canadian crypto news actually means for your money every single week. Next up, I'm covering how Canadian banks' crypto products compare fee by fee against buying directly on an exchange. You won't want to miss that one. What's your biggest question about bank-backed crypto ETFs? Drop it below. I read every comment.